The first trading day of 2026 hasn't even opened yet, and the market has already told us everything we need to know about what's coming. While most traders were celebrating New Year's Eve, the S&P 500 closed out 2025 with 4 consecutive days of decline despite posting a 16.6% annual gain. Think about that for a moment. Good news met with selling, strength met with distribution, optimism met with exhaustion. I've spent the last 15 years studying how human psychology creates exploitable patterns in markets, and what I'm seeing right now is textbook late-cycle behavior, the kind that separates disciplined investors from the crowd that's about to get humbled. If you're holding positions based on momentum from 2023 to 2025, or if you're wondering why Bitcoin dropped to 86,000 despite all the institutional adoption narratives, this breakdown will show you exactly what's happening beneath the surface, and more importantly, how to position yourself while others are still fighting the last war. So today, I'm going to walk you through the 3-layer analysis that reveals why January 2026 might be the month that changes everything. We'll examine the human psychology driving current positioning, decode what the system is actually telling us through price action, and outline the Stoic response that exploits this setup rather than becoming victim to it. Let me start with something that should concern every investor right now. The Shiller P ratio just hit 40.74, the second highest level in 154 years of market history. The only time it was higher, December 1999. We all know how that ended, but here's what's fascinating about human nature. This number should terrify rational investors, yet markets kept climbing through December. Why? Because 3 consecutive years of double-digit returns create a psychological momentum that overrides mathematical reality. The human brain, designed for pattern recognition, convinces itself that this time is different, that AI and productivity gains justify valuations that would have been laughable in any previous era. The crowd isn't stupid, they're predictably human. Fear of missing out on the 4th consecutive year of gains overrode fear of losing capital, until it didn't. Those 4 days of decline into year-end, that's when reality began reasserting itself. When jobless claims dropped to 199,000, well below the 218,000 consensus, markets should have rallied. Instead, they fell. This divergence exposes the truth. Positioning fatigue, not fundamental deterioration, is driving price action. Look at crypto for the clearest example. Bitcoin's RSI at 33, Ethereum at 32.5, technically oversold, yet the selling continues. This isn't panic, it's the methodical unwinding of leverage by participants who understand that 4-year cycles carry statistical weight, even if they're not deterministic. The narrative of corporate treasuries and sovereign adoption remains intact, but narratives don't stop profit-taking when the calendar turns. Now let's examine what the system is actually telling us through price action and structure. The market closed 2025 with a technical breakdown masked by strong annual returns. This is critical to understand. The S&P 500's 16.6% gain, Nasdaq's 20.4%, Dow's 13.2% represent the 3rd consecutive year of double-digit performance. Since 1950, this pattern has occurred only 5 times. Each previous occurrence either ended in year 4 or extended to 5 years before mean reversion. The system is now testing whether 2026 breaks this pattern or conforms to it. But here's where it gets interesting. Sector breadth remained positive across all 11 S&P sectors through December, yet this masks dangerous concentration risk. The Magnificent Seven continued to dominate returns while equal-weight indices lagged significantly. This isn't broad-based strength, it's narrow leadership approaching exhaustion. Classic late-cycle behavior. Macro forces are tightening like a vice. Fed minutes revealed divisions on the pace of 2026 rate cuts, with the terminal rate likely settling near 3% rather than the 2.5% markets priced earlier. The labor market remains resilient. 199,000 jobless claims, 1.86 million continuing claims indicate no imminent recession. This removes the Fed's urgency to cut aggressively, which removes a key support for equity multiples. The dollar's 9% decline in 2025 provided stealth stimulus that's now reversing. Oil down 20% to $57 reflects oversupply and weakening global growth, not geopolitical calm. Meanwhile, gold up 72%, silver up 160%. These parabolic moves signal monetary debasement fears and positioning for fiscal instability. When silver's RSI hits 90, that's not a buy signal. That's exhaustion. Commodities, currencies, crypto, equities, They're all telling the same story. The easy money phase is ending. Here's what the Stoic approach demands in this environment. First, recognize that the absence of fear is not the same as the presence of safety. Markets that decline on good news are markets where positioning, not fundamentals, drives price. This is exploitable, but only if you resist the human tendency to fight the tape. The 4-year cycle in crypto and 3-year streak in equities aren't laws of nature, but they are patterns that emerge from the interaction of leverage, sentiment, and liquidity. The current drawdown isn't a signal to abandon these asset classes. It's a test of whether structural theses can override cyclical patterns. The answer will be revealed in Q1 2026, not in holiday-thinned January trading. Valuation at 40.74. Shiller PE doesn't predict timing, but it defines magnitude. When markets trade at twice their historical average, downside risk isn't 10 to 15%, it's 30 to 50% if sentiment shifts. The Stoic exploiter doesn't attempt to time this shift. We structure positions to survive it. This means 3 things. Reduce exposure to momentum-driven names that require perfection to justify current prices. Increase allocation to cash-generative businesses trading below market multiples. They exist, you just have to look beyond the headlines. And maintain dry powder for dislocations, because when they come, they'll be swift and severe. The labor market's resilience removes the recession narrative that would justify aggressive Fed easing. This is bullish for the economy, but neutral to bearish for equity multiples. The Fed's division on cuts signals data-dependent policy, not preemptive accommodation. Markets don't price uncertainty efficiently. They oscillate between complacency and overreaction. Gold and silver's parabolic moves aren't signals to chase, but signals to fade. When RSI reaches 90, the trade is exhausted regardless of narrative. The same logic applies to the Magnificent Seven, 3 years of outsized returns, valuations requiring perfection. The Stoic exploiter doesn't argue with thesis, we simply recognize when risk-reward has inverted. The first week of January will provide clarity. ISM, manufacturing PMI, jobless claims, jolts. Data will reveal whether labor market resilience is sustainable or beginning to crack. More importantly, the market's reaction to this data will reveal whether year-end weakness was profit-taking or the start of something deeper. But here's the key insight that separates systematic thinkers from the crowd. The setup entering 2026 isn't bullish or bearish, it's fragile. Fragility demands respect, not conviction. It requires positioning for multiple outcomes rather than betting on single scenarios. The crowd will spend January debating whether the bull market continues or the bear market begins. The Stoic exploiter recognizes this is the wrong question. The right question is, how do we structure portfolios to exploit human predictability regardless of direction? Because at the end of the day, markets are exploitable not because they're random, but because human beings are predictably irrational. And January 2026 is setting up to prove this point once again. If you value systematic analysis over market noise and want to build the psychological framework that exploits human predictability rather than falling victim to it, subscribe to this channel and grab the complete Stoic exploiter methodology in the link below, because understanding the game is only half the battle. Playing it correctly is what separates those who survive market cycles from those who merely endure them.